Welcome to BWC News. I am Elizabeth. The U.S. debt ceiling dispute remains at an impasse as negotiations between the White House and the U.S. Congress on raising the $31.4 trillion debt ceiling break down for the second time. It is reported that in the latest negotiations, the House of Representatives negotiators once suddenly left the table. A negotiator said the White House is not reasonable, the negotiations suspended. U.S. House Speaker McCarthy said they would not approve an increase in the federal government's borrowing limit if there was no agreement on significant spending cuts. That is, progress needs to be made in changing the trajectory of U.S. government deficit spending and rapidly rising debt. In short, McCarthy said, we have to spend less than we did the year before. The impasse in the current round of U.S. debt ceiling negotiations sparked panic on Wall Street, causing the three major U.S. stock indexes to fall collectively at one point. However, after Federal Reserve Chairman Jerome Powell put out a relatively dovish expected to suspend interest rate hikes that day, reversing the decline in U.S. stocks. Powell said the U.S. banking sector pressure will affect the Fed's interest rate path. If the credit environment tightened due to the banking crisis led to an economic slowdown, the Fed may not have to let interest rates rise to a high level as they should. After 10 rate hikes since last March, which has seen the benchmark federal interest rate rise as high as 5% to 5.25%, the Fed appears to be sending a clear signal of softness for more than a year. It also conveys that the U.S. banking crisis is more serious than one might think. According to seasonally adjusted data released by the Federal Reserve on May 19, U.S. commercial bank deposits fell by $26.4 billion to $17.1 trillion in the week ending May 10, with large banks accounting for a larger share of the deposit losses at $21.6 billion. This means that people still do not trust the creditworthiness of the U.S. banking sector, and even some Americans fear that their previously existing U.S. bank deposits face a situation similar to the March Credit Suisse Additional Tier 1 capital bond was cleared, resulting in the relevant international investors lost their money and had to flock to the U.S. banks to withdraw their deposits. Although it is widely believed that eventually the White House and Congress will reach an agreement to end this debt strife and avoid a U.S. debt default. But there are some predictions that the U.S. Congress may rewrite the history of the debt ceiling was raised endlessly. HSBC analysts believe that a long-term default will cost the U.S. economy dearly, and the White House has very high expectations for the cost of a long-term default, arguing that the economic cost of a long-term default is huge, with a long-term default expected to cost the U.S. 8.3 million jobs, a 6.1% drop in real GDP, and a default lasting a full fiscal quarter, with the U.S. stock market plunging 45%. In the long run, the U.S. economy to any time dare not default, because a long-term default means the economic credit bankruptcy of the United States and the dollar, which will bring a fatal blow to the financial currency and debt system created by the U.S. economy in the global arena over the years. That is, the world will have to launch a claim to the U.S. economy and the dollar, and will even trigger the risk of the complete abolition of the dollar reserve status, and thus the U.S. economy. Easily gain the core advantage of the global valuable material wealth will no longer exist, which is almost impossible for the White House economic team to resist, and is also the U.S. Congress does not want to see. You know, before the U.S. has defaulted, at least 112 countries around the world have already started to de-dollarize in different ways in advance. Based on this, even if there is a short-lived default, such as the June maturity of the 1-month or 2-month U.S. Treasury bills after the possibility of not being able to pay the first time, the U.S. debt ceiling may be the first time to pass. In turn, it will continue to monetize the U.S. debt and increase the greed for debt and money printing. Because from the latest soft signal from Fed Chairman Powell, it is almost predictable that not only may interest rate hikes stop soon this year, but may even at some point restart the dollar QE money printing machine and start a new cycle of harvesting. As of May 20, 6 U.S. states, Utah, Wyoming, Oklahoma, Missouri, Texas, and Arkansas, have declared that gold and silver can circulate as currency and can replace the legal tender function of the U.S. dollar. At the same time, at least 43 U.S. states have waived sales tax on gold and silver. According to former U.S. Congressman Ron Paul, we should not tax gold and silver as real money, while the dollar is just green paper and not real money. With the U.S. Treasury and the Federal Reserve constantly abusing the status of the U.S. dollar by printing money at will and the U.S. federal debt is high, many Americans prefer to abandon the green paper of the U.S. dollar in favor of real money because it is fair to all, not just the bankers on Wall Street who benefit. We synthesized the previous multiple signs and analyzed that the day of the Fed's new monetary cycle may also be accompanied by the time when the U.S. debt ceiling is raised. Once interest rates are sharply lowered, or even reapproach negative levels at some point, China, Japan, and many other countries that hold U.S. treasuries will have to make payments to the U.S. because they hold U.S. treasuries. This is one of the deeper reasons why the U.S. Treasury and the Federal Reserve are thus reciprocating the cycle of monetary initiatives and harvesting global wealth indefinitely. It is the U.S. debt economy model and the series of signs of unreliability of the U.S. dollar that have catalyzed the process of accelerating the increase in gold reserves by global central banks. Global central banks have increased their gold reserves to another record high. China has increased its gold reserves by 128 tons for 6 consecutive months since November last year until April this year, bringing them to a record high of 2,076 tons, or about 3.9% of foreign exchange reserves. However, compared to European countries such as Germany, France, and Italy, where gold reserves account for about 65% or more, there is more room for China to increase its gold reserves. Although according to the U.S. Treasury Department report this month, China increased its holdings of U.S. Treasuries by $20.5 billion in March and remains the second largest holder of U.S. debt, the current holdings of $869.3 billion in U.S. debt is still a historical low, and the possibility of a sudden and large sale of U.S. Treasuries and a large replacement for gold cannot be ruled out at some point in the future. According to multiple analyses, there is a possibility that China will suddenly sell as much as $800 billion in U.S. treasuries at some point in the future, or even empty them all. This is a situation that the U.S., which is highly dependent on debt and fears an economic and financial disaster induced by a debt default, does not want to see. A sell-off of this magnitude would accelerate the collapse of U.S. treasuries and trigger the U.S. debt economy model into liquidity exhaustion. This explains why some on Wall Street and in the U.S. Congress have already advised the U.S. Treasury to prioritize payments to China and ship gold to offset maturing debt ahead of a possible U.S. debt default. The only way to avoid a potential financial disaster seems to be to avoid defaulting to China. It's the end of this video. Thank you for watching. Please subscribe to the channel to support. See you next time.